Nvidia Stock. 4 major investor worries are broken down by Bank of America. Following the U.S. government's April 15th ban on shipping of its H20 chips to China, Nvidia stock has dropped 14% in recent weeks. In spite of the continued concerns, Bank of America analysts contended in a note on Tuesday that the sell-off might offer a buying opportunity. BofA listed 4 major issues that investors are currently facing in a note to clients: gross margins, cloud capital expenditure visibility, new AI diffusion export regulations, and China sales. The company thinks the overhang associated with China is mostly priced in. According to the analysts, China accounts for 13 to 14% of sales, but the 3 to 6% DC decrease is already fully baked in. They said, "We consider exposure to China and H20 to be generally de-risked." According to BofA, the decrease is entirely baked into its updated EPS projections for fiscal 2026 and 2027. The largest short-term danger is thought to be the AI diffusion rule, which might go into effect as early as May 15th. The worst-case scenario, according to BofA, is an additional 10% in sales and an EPS cut of up to 11% from our revised base case. However, the analysts pointed out that Nvidia would be trading at a far lower historical 30x median today at roughly 19x CY26 PE. It is anticipated that pressures on gross margins from cost inflation and sales reductions will eventually subside. According to BofA, as Blackwell expands and Blackwell Ultra ramps, we anticipate that margins will generally rise throughout F2H. Regarding cloud capital expenditures, there is still no insight into 2026. According to the letter, cloud capex would probably require a few more quarters before CSPs could provide greater CY26 visibility. BofA maintained a buy rating for the stock, noting Nvidia's present pricing and long-term earnings potential, even though it lowered its price objective from $160 to $150. The experts came to the conclusion that we see the current stock volatility as an enhanced buying opportunity. Following the company's announcement last week that it will incur a charge of up to $5.5 billion for China export restrictions, Nvidia's stock fell precipitously. According to the company, it will no longer be able to export its H20 chip, a less potent variant of its H100 GPU that was made to adhere to previous export regulations, without a license. According to Nvidia's petition, obtaining a license seems doubtful. The impact on Nvidia's financial performance was estimated differently by Wall Street experts. According to Wedbush, the restriction would result in a 10% decrease in its revenue. According to Bank of America, in 2025 and 2026, revenue would drop by 9% to 13% in the event of a disastrous tariff situation. Since the $5.5 billion charge represents the cost of the chips rather than their selling price, Nvidia's revenue will be reduced by more than that amount. Since Nvidia reported $17.1 billion in revenue in fiscal 2025, which ended in January 2025, or 13% of its total revenue, the loss of income from China should be kept to about the 10% the analysts are estimating above. It appears that the portion of Nvidia's revenue that comes from China would have decreased this year as well, as it has in each of the company's previous 2 years. Although it's unclear if Nvidia intends to replace the H20 with a less potent processor, political pressure may force the company to abandon China entirely because the export limits aren't its only problem. The House Select Committee, which focuses on the Chinese Communist Party, CCP, launched an investigation on Wednesday and demanded answers from Nvidia on its connection to the Chinese AI startup DeepSeek. According to the paper, DeepSeek poses a serious national security threat because its models require tens of thousands of Nvidia chips to operate. DeepSeek is intended to spy on Americans and steal our technology, according to committee chairman John Moulinar, who also claimed that it made use of advanced Nvidia chips that should never have ended up in CCP hands. The report further claimed that after previous limitations, Nvidia CEO Jensen Huang directed the company to design a modified chip specifically to exploit regulatory loopholes. The committee also wrote to Nvidia to obtain information pertaining to the company's customer interactions in China and Southeast Asia, voicing concerns that corrupt actors were rerouting its chips to China in violation of U.S. export regulations. Nvidia responded to the committee with a statement that read, "We strictly adhere to the government's directives." It's unclear if Nvidia will face any repercussions from the inquiry. Despite being a considerably smaller firm for the majority of its existence, the corporation has never before been hit with a sizable fine for its business methods. So what implications does this have for Nvidia's stock? Let's explore that. But first, a big thank you to those of you who've stuck with us this far. Creating these videos takes significant effort and dedication, so if you're enjoying the content, Please hit the like button, subscribe to our channel, and share your thoughts on Nvidia stock in the comments. Your support truly helps us grow. Now, let's get back to the video. In 2022, it disclosed information about cryptocurrency mining and its gaming graphics processing units, GPUs, that led to a $5.5 million punishment by the Securities and Exchange Commission, SEC. It is currently being investigated for antitrust violations in China and France. From a different angle, the Congressional probe is virtually a compliment to Nvidia and its technology, even though it may temporarily damage the company's brand. The committee's decision to single out Nvidia is effectively stating that the company's technology is so potent and desirable that it has to be carefully protected in order to prevent the United States from lagging behind its main international competitor. American innovation should never be the engine of our adversaries' ambitions, Representative Moulinar said as he wrapped up his remarks, despite the fact that the innovation in question is Nvidia's, not the United States. The government appears to be providing Nvidia preferential treatment by handling its chips as though they were nuclear secrets. This incident might only enhance Nvidia's reputation if the inquiry finds that the business has acted legally in its interactions with China and the surrounding area. Nvidia can overcome the disappointing $5.5 billion charge and the resulting loss of business in China. More destructive would be harsh government sanctions. However, if Nvidia's identity is cleared by the probe, the stock appears to be a sure bet because the business may be facing its greatest threat at the moment: federal limits and interference. Although many investors are worried about how tariffs would affect Nvidia's stock, the company has already taken action to get around them. All of its most potent GPUs will be made in the United States. The fact that some of our most important products won't need to be imported is a huge triumph for the nation. However, Nvidia cannot suddenly switch to producing Blackwell GPUs in the United States, so there are still a few important things to be aware of. Nvidia declared that all of its Blackwell chips, which are currently the company's most potent graphics processing units, GPUs, will be made in the United States. Although this won't happen right now, production is anticipated to increase over the course of the following 12 to 15 months. These GPUs' final assembly will take place at Nvidia's plant in Texas, with components sourced from Foxconn's facility in Houston, Wistron's site in Dallas, and Taiwan Semiconductor Manufacturing's chip facility in Phoenix. President Trump has hinted at an impending semiconductor tariff, which Nvidia might not be able to avoid, but there might be exceptions for businesses who intend to relocate their manufacturing to the United States. Investors won't have to worry as much about how tariffs would affect Nvidia because the company will be able to resolve these issues in the upcoming months. They can instead concentrate on AI. Even though tariff concerns have overshadowed AI progress, it is still happening. This is a once-in-a-lifetime chance, and businesses who are hesitant to invest in AI infrastructure risk being overtaken by rivals. This is a major factor in Nvidia's prediction that capital expenditures for data centers would increase from $400 billion in 2024 to more than $1 trillion in 2028. Given that Nvidia receives a sizable portion of the data center spending and that its data center business produced $115 billion in the previous 12 months, its revenue will rise in tandem with the capital expenditures. However, some are worried about what will happen to some of Nvidia's overseas shipments under the Trump government. Nvidia was recently had to write off $5.5 billion in inventory for H20 chips that were made especially to satisfy export regulations for processors that might be shipped to China. Nvidia will bear the expense of those chips in its first quarter fiscal year 2026 results because the regulations have changed and they can no longer be exported. Although this would reduce Nvidia's quarterly profits, the firm won't be significantly impacted because as of the end of Q4, it had about $43.2 billion in cash and equivalents on its balance sheet. However, Nvidia's stock was sold off by 5% as a result of the market's reaction to the news. A 5% decline now translates into a $135 billion market cap loss for Nvidia, which has a $2.7 trillion market cap. This news obviously caused the market to overreact, which creates a great opportunity to buy. Instead of writing off the past, investors should focus on the future, which includes building data centers for AI and GPUs manufactured in the United States. It's evident that Nvidia still has a lot of exciting things ahead of it, and the price you pay now is a tremendous bargain. At 23 times prospective earnings, Nvidia's stock is currently just marginally more expensive than the S&P 500 index, which represents the market as a whole, which is trading at 19.8 times forward earnings. We know that Nvidia has several years of robust growth left because of data center construction, even if the future PE ratio only accounts for 1 year of growth. This makes Nvidia an obvious choice in this case, and investors should concentrate on the company's future plans rather than the immediate tariff concerns that won't be as significant now that Nvidia has moved its Blackwell manufacturing to the United States. To stay informed about the latest developments from Nvidia and the ever-changing stock market, consider subscribing to our investing tutorial channel. We provide daily updates on significant market shifts and key catalysts, so hit that subscribe button to ensure you never miss crucial information. We'd love to hear your thoughts on Nvidia stock, so please share your opinions in the comments below. Now let's dive into today's video. As early as next month, China-based Huawei Technologies is to start shipping its 920C AI processor in bulk to domestic customers, according to Reuters, which cited 2 people with knowledge of the situation. In response to U.S. export restrictions, China is looking for alternatives to Nvidia's AI chips. According to the source, some 910C exports have already taken place. The graphics processing unit, GPU, 920C is an improvement on the company's 920B model. The 910C is an architectural advancement rather than a significant technology advancement, according to one of the 2 individuals and a third source with knowledge of its design who spoke to Reuters. The sources said that the 910C offers performance on par with Nvidia's H100 chip, thanks to sophisticated procedures that combine 2 910B chips into a single unit. It has twice as much processing power and memory as its predecessor, and it has improvements to handle a variety of AI data workloads. Over what it called conjecture over the chip's capabilities and delivery schedule, Huawei declined to comment. The move coincides with the U.S.'s ongoing efforts to deny China access to cutting-edge U.S. semiconductor technology. Prior to its formal launch in 2022, the U.S. government prohibited the sale of the H100 in China and required export licenses for Nvidia's H20 processor. Domestic firms including Huawei, More Threads, and Iluvatar Corex now have more chances to grow in the regional AI chip industry thanks to these policies. In late 2024, Huawei reportedly started taking orders and sending samples of the 910C to tech companies. According to a source, China's Semiconductor Manufacturing International Corporation, SMIC, is employing their N+2 7nm process to make some of the GPU's components, but chip yield is still low. Furthermore, according to one source and another individual, at least some of the 910C processors use semiconductors that were first produced by Taiwan's TSMC for SoftGo, a Chinese business. Following the discovery of one of these chips in Huawei's previous 910B model, the U.S. Commerce Department has been looking into TSMC's participation. According to Reuters, TSMC said it conforms with legal criteria and hasn't supplied Huawei since September 2020. China looks beyond Nvidia as Huawei prepares to ship 910C AI chip, report, was first written and released by Verdict, a company owned by Global Data. Artificial intelligence, AI services are in high demand. By 2033, the market is expected to be worth $4.8 trillion according to some projections. Do you want to ensure the benefits of your portfolio? The development of AI should greatly benefit all 3 of these stocks. However, each has a slightly varied exposure angle. Nvidia continues to dominate the AI investment market. According to most estimations, Nvidia holds a 70% to 95% market share for AI GPUs, which are necessary for AI models to function. Meanwhile, the preferred platform for modifying these chips for AI applications is still its CUDA developer program. Nvidia's present dominance was made possible by its early investments in AI-specific GPUs and the 2006 launch of its CUDA platform. In a nutshell, Nvidia's current dominance has long been anticipated. Even as competition heats up, I anticipate that Nvidia will maintain its dominant market share for many more years to come, thanks to its exceptional vendor lock-in through its CUDA development suite and larger investment capacity than its rivals. With a 25% year-to-date decline, this tried-and-true winner now provides long-term investors with a discounted entry point. Do you believe that Amazon is an online retailer? Rethink your thought. Similar to Nvidia, Amazon is at the forefront of the AI revolution, but the majority of regular investors are not aware of this. Amazon's AI exposure is largely due to its Amazon Web Services AWS segment. AWS can be thought of as a distributed global computer that can be scaled up or down at will. Given that their applications need a significant amount of processing power to train and run their models, it is a tremendous advantage for AI engineers. Compared to creating their own infrastructure, they can accomplish this far more quickly and affordably with cloud infrastructure like AWS. With double-digit growth in sector revenues, AWS accounted for almost half of Amazon's overall operating profitability last year. For years to come, Amazon will continue to be at the forefront of the AI revolution because to its 30% global market dominance in cloud infrastructure. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve. The development of artificial intelligence, AI, has captured the interest of investors more than any other topic in the past 2 years. Without the assistance of human interaction, software and systems may act, reason, and possibly even adapt to acquire new skills, giving this technology an apparently endless potential. AI has the potential to boost the global economy by $15.7 trillion by 2030 through a combination of increased productivity and other consumption side effects, according to PwC's Sizing the Prize. No firm has benefited more in the early going than chip giant Nvidia, which is a huge addressable market. The Blackwell GPU architecture and Nvidia's Hopper H100 graphics processing units, GPUs, quickly seized a monopoly-like portion of the AI GPUs utilized in high-compute data centers. During the fiscal first quarter of 2025, which concluded on April 28, 2024, the company's hardware saw overwhelming demand due to AI GPU scarcity, which resulted in outstanding pricing power and a generally accepted accounting principles GAAP gross margin of 78.4%. However, Wall Street's euphoria for its AI darling has significantly soured over the past week, and I believe this is probably only the beginning. Although Wall Street analysts' opinions are frequently subject to change, their price targets serve as pillars that assist investors in determining how they feel about a firm in the long run. 8 Wall Street analysts lowered their Nvidia price target last week. D.A. Davidson's Gil Luria reduced his company's price target from $125 to $120. Bank of America Securities' Vivek Arya reduced his company's price estimate from $200 to $160. Piper Sandler's Harsh Kumar reduced his company's price target from $175 to $150. Raymond James's Srini Pajuri reduced his company's price target from $170 to $150. The price estimate set by UBS's Timothy Arcuri was reduced from $185 to $180. Rosenblatt's Kevin Cassidy reduced his company's price target from $220 to $200. Wolf Research's Chris Caso reduced his company's price target from $180 to $150. Argus Research's Jim Kelleher reduced his company's price target from $175 to $150. Most of these price target changes followed Nvidia's April 15th regulatory filing, in which it revealed a possible $5.5 billion damage related to exports of its powerful H20 processors to China. Nvidia stated that in order to sell the H20 chip to the second largest country in the world by gross domestic product, it would require a special permission. This filing shouldn't come as a surprise, though. The Joe Biden administration imposed strict regulations on the transfer of AI accelerating chips and equipment to China for 3 years before Donald Trump assumed office. The A800 and H800 chips, which are AI GPUs that Nvidia created especially for the Chinese market, were placed on the banned export list by the Biden administration. Although some investors may view this blunder as the perfect chance to purchase shares of Wall Street's AI darling at a discount, it's possible that we're seeing the start of a trend of analyst price target reductions for Nvidia. As previously mentioned, Nvidia was able to charge more than $40,000 for its Hopper processor early last year due to a combination of high demand and restricted availability. This led to the previously indicated 78.4% GAAP gross margin. Nvidia's GAAP gross margin, however, has decreased in every succeeding quarter. Q1 2025, 78.4%, Q2 2025, 75.1%, Q3 2025, 74.6%, Q4 2025, 73%, and Q1 2026 estimated 70.6%, 50 basis points. This lowering is a result of both a reduction in AI GPU scarcity and an increase in competition inside AI-accelerated data centers. Although the majority of investors are still intent on direct rivals to Nvidia's hegemony in data centers, the company's greatest internal danger has emerged. The majority of the Magnificent Seven, who also happen to be among Nvidia's top clients in terms of net sales, are working on their own AI GPUs and solutions. These chips are far less expensive than Nvidia's AI GPUs, and there is no backlog, despite the fact that they won't be sold externally and are probably going to be slower than Nvidia's technology on a computational basis. With every quarter that goes by, Nvidia's data center space is being eroded by these in-house processors. This in turn should gradually lessen AI GPU scarcity and the pricing power that has driven Nvidia's stock to rise parabolically, in my opinion. Nvidia's product replacement cycle is a second problem that is probably going to push Wall Street's price forecasts for the company down. In the tech industry, innovation is typically crucial. When it comes to computational speed and AI-accelerated data centers, Nvidia's Hopper and Blackwell chips are the undisputed leaders. Because of this, Nvidia's full-year sales have increased dramatically, rising from $27 billion in fiscal 2023 to over $130 billion in fiscal 2025. Nvidia's quick innovation and ambition to keep its computational advantage, however, would not sit well with its present or potential clients. Late last year, Nvidia started releasing Blackwell after launching the Hopper. In 2026, the Vera Rubin GPU architecture is anticipated to make its debut, and in the second half of 2027, the Vera Rubin Ultra will follow. The brand new Vera CPU will be included in both Vera Rubin chips. However, launching a new AI GPU every year has a price. The value of the AI hardware investments made by earlier purchasers is probably going to drastically decline. Furthermore, the gains in energy efficiency, high bandwidth memory, and computation capacity that are seen from year to year are probably going to wane with time. To put it another way, Nvidia's customers, particularly its largest ones, have less motivation to make large investments in the newest hardware. Not to mention, history will probably push Wall Street's price forecasts for the business even lower. For a significant portion of the past 3 decades or more, investors have been captivated by the next big thing in technology or innovation. Despite the fact that each of these trends presented lucrative target markets, they were all characterized by the possibility of a bubble-bursting event. Every next big thing craze, starting with the internet in the mid-1990s, has passed through a bubble. Bubbles arise for the straightforward reason that investors overestimate the early uptake and/or usefulness of a new invention or technology. The bubble bursts when high investment expectations are eventually not fulfilled. It is impossible to overlook the fact that the majority of companies investing in AI have not yet optimized their solutions or produced a profitable return on their investments, despite Nvidia's phenomenal demand for their AI hardware. We're seeing all the same warning indicators that investors have overstated AI's early acceptance and practical applications. The good news is that a lot of these revolutionary trends ended up being profitable. However, it is an indisputable fact that every new and innovative technology requires a considerable amount of time to develop. AI is still far from being a fully developed technology. An eventual bubble-bursting event would probably affect Nvidia more severely than other AI equities because it has profited more than any other public firm from the development of artificial intelligence.